Okay, here's a question for you. In a world that's just constantly being disrupted, you know, tech giants changing everything overnight, consumer tastes shifting like crazy with every trend, can a company that's over 200 years old, basically selling toothpaste and soap, still give you market-beating returns for the next, say, 10 years? That's not just theoretical. It's really the core thing we're digging into today. We're asking if Colgate-Palmolive, that Ciarello on the NYSE, is maybe a forgotten powerhouse, ready to surprise us even now, or if its best days are really behind it. So our deep dive today, it's all about exploring whether this seemingly boring but actually really powerful business still has that resilience, that competitive strength to keep thriving.
That's exactly right. And just for clarity, this is a comprehensive look at Colgate-Palmolive Company. All the data we're using is anchored to July 14, 2025. And the closing share price we're referencing, that was $89.58 on July 11, 2025.
Okay, let's unpack this then. We want to give you a shortcut to being really well informed on CL. Expect some surprising facts, some crucial insights along the way. All right, let's dive in. Part 1, business, management, and financials. And we'll start with Chapter 1, business analysis. So, at its heart, Colgate-Palmolive. It's like a masterclass in keeping things simple but executing globally. They focus on those high-frequency, low-cost, essential products, right? Things you use every day for health and hygiene. And that business model, it's inherently defensive. Demand stays pretty stable, regardless of what the wider economy's up to.
Exactly. And if you look into their 2024 10K, their big annual filing, you see two main product segments. The first one, the biggest by far, is oral, personal, and home care. That makes up about 78% of their total revenue. Oral care alone is 43% of worldwide net sales. Then you have personal care at 18% and home care at 17%. This is really, like you said, the company's cash engine.
Okay, so if that's the engine, how does something like pet nutrition fit in? The Hill's brand seems a bit different from toothpaste and soap. What's the strategy there?
That's a really good question because it's definitely a strategic move. Pet nutrition, under the Hill's brand, brought in about 22% of net sales in 2024. Its importance. Well, it diversifies them into the pet health market. That's often higher margin, more science-driven, and maybe less tied to the same economic cycles as, say, soap.
And it's not just the product mix, it's where they sell it. Colgate-Palmolive's resilience, it really comes from this incredible global mosaic of revenue. Think about it, if one big economy struggles, it hits most companies hard. But Colgate, their revenue in 2021 was spread out. North America, 21%, Latin America, 21%, Europe, 16%, Asia-Pacific, 17%, Africa-Asia, 6%, and Hill's globally was 19%. It's like a built-in shock absorber. So around 70% of the revenue is international. And get this, 45% comes from developing economies. That positions them not just for stability now, but for that long-term growth as those economies expand.
And holding all that together is this portfolio of just iconic brands. In oral care, you've got the flagship Colgate, obviously, but also Tom's of Maine for the natural segment, and specialized ones like Elmex and Meridol. Then personal care, Palmolive, soft soap, Irish Spring, Speed Stick, Sanex, them. Home care, you've got Ajax, Fabuloso, Suavitel. And in pet nutrition, the Hill's brand is clever. They have Hill's Science Diet for everyday wellness, sold broadly, but then Hill's Prescription Diet, that's veterinarian exclusive. That dual approach is pretty smart for capturing different parts of the pet market.
And their market position. It's not just big, it's dominant. Especially in oral care. We're talking a global market share of 41.6% in toothpaste and 32.3% in manual toothbrushes. They sell stuff in over 200 countries. That scale is just immense.
Yeah. So the primary value proposition is pretty straightforward. For consumers, it's trusted, effective products they use daily, often backed by science. And for investors, it translates into that defensive business profile, predictable cash flows, that consistently growing dividend, and long-term stability. Things investors really value, especially when things feel uncertain.
Okay, so we've got the core business, the amazing reach. But how does Colgate fit into the wider consumer staples world? What trends are shaking up this seemingly, mature industry? Let's look at the industry analysis part of Chapter 1.
Right, because even though it's mature, the consumer staples sector is definitely not standing still. There are some big trends pushing things. First, there's the big shift to e-commerce and digitalization. People are buying more online, that's obvious. And companies are using AI now for things like dynamic pricing, optimizing supply chains, getting really specific with targeted marketing. Second, the whole sustainability and natural products movement. Consumers want healthier stuff, environmentally friendly options, less plastic. If companies don't adapt here, they really risk, losing relevance. And third, premiumization. People are often willing to pay a bit more for better benefits, which helps brands improve their product mix and margins.
So what's the battlefield look like? Who are they fighting against day to day?
Oh, it's definitely a battlefield. Fiercely competitive. You've got the giants, obviously Procter& Gamble with Crest, Unilever, their major rivals. But there's also this growing threat from private label or store brands. They offer similar stuff, often cheaper, appealing to budget-conscious shoppers. And for many of these daily items, switching costs for consumers are pretty low, which just ramps up the competition.
And then there's all the red tape, right? Navigating regulations globally. You mentioned the FDA, EPA, CPSC in the US, but multiply that by 200 plus countries. That sounds complex.
It is complex, yeah. But what really gives Colgate-Palmolive that strong economic moat, as investors call it, are the high barriers to entry. First, just the sheer brand strength and consumer trust. I mean, for many people, Colgate is toothpaste. That trust, built over centuries, is incredibly valuable, especially now with so much information flying around. Second, that global distribution network. Getting good shelf space with giants like Walmart, Walmart's about 11% of their total sales, that's really tough for newcomers. And third, economies of scale. They have 39 manufacturing plants, massive production volumes that lets them get better prices on raw materials and run super efficient operations. Small players just can't match that.
So, boiling it down, their core competitive advantage really is the power of those brands. It's like a mental shortcut for shoppers, leading to habitual buying, almost automatic.
And those cost advantages flow directly from the scale. Centralized buying, efficient global supply chain, it means lower cost per unit, which fuels those impressive profit margins we see.
And you also have those soft switching costs, just consumer habit and trust. Once you find a toothpaste or soap you like for your daily routine, you tend to stick with it, right? That makes for a sticky customer base, predictable revenue.
Definitely. And don't forget their unique assets. They've got a big patent portfolio, over 1,500 active ones, a global R&D team always working on stuff. But maybe the most unique asset is that Hill's pet nutrition business model. Selling through vets and specialty pet stores, especially the prescription diet line, that gives them a powerful professional endorsement and creates really high switching costs for pet owners. It's a smart move into a sort of healthcare-related market with pricing power.
Okay, let's pivot now and look at the people running the show. Chapter 2, Management Evaluation. Noel R. Wallace, the CEO, he's a real company insider, joined back in 1987. So he brings this deep operational understanding. And actually, his score on comparably is pretty high, 79 out of 100, which puts him in the top 5% of CEOs at similar companies.
Yeah, and a good test of leadership is often how they handle a crisis. Think about the COVID-19 pandemic. They quickly shifted production, donated millions of bars of soap. That showed social responsibility, but also, importantly, supply chain resilience. Now, for a balanced view, you do have to acknowledge past issues, like some price-fixing allegations back in 2009. That was before Wallace was CEO, but it's a reminder of the regulatory risks these big global companies always face.
And looking at what they say publicly, they seem to emphasize transparency, ethical reputation. They've had a code of conduct since '87. They're part of the UN Global Compact.
Right, and this is important, especially for investors focused on ESG, environmental, social governance factors. While those public commitments look good, some watchdog groups, like Ethical Consumer or the Rainforest Action Network, they've criticized Colgate for what they call a SADO gap, specifically around things like plastic pollution and sourcing palm oil sustainably. So that highlights a potential reputational risk. If their actions don't quite match their words, it could put off some ESG-focused investors.
Okay, still in Chapter 2. Management evaluation, let's talk about how they spend their money. Capital allocation. It looks like a pretty disciplined approach. They focus on bolt-on acquisitions, smaller additions, like buying Tom's of Maine or Hello products to get into natural oral care, or Eltemd and Filorga for skin health. And their capital spending, their CapEx, it's fairly modest, around $588 million a year on average from 2020 to 2024. That really screams cash cow business, doesn't it? Generating lots of cash.
Absolutely. And the cornerstone of how they return that cash to shareholders is their status as a dividend aristocrat. That's just incredible. 62 consecutive years of dividend increases, uninterrupted since 1895. The latest hike was in March 2025, up to $1.52 per share quarterly. And on top of dividends, they're active with share buybacks. They authorized another $5 billion for repurchases in March 2025. That helps boost earnings per share by reducing the share count.
Yeah, you can really see that consistency if you track the dividend per share. It went from like $1.50 back in 2015 up to $1.98 in 2024. Just a steady climb. Great for income investors.
Now, a key metric for judging management effectiveness is return on invested capital, ROIC. And Colgate's is stellar. Their TTM, or trailing 12 months ROIC, is between 28.8% and 34.5%. That's dramatically higher than their estimated cost of capital, their WACC, which is around 5.79%, and their 5-year average ROIC, 39.7%,
Yeah.
among the best in the sector. It proves they create substantial economic value with the money they invest.
But wait, if they're so good at generating returns on capital, it does make you wonder why the relatively modest level of reinvestment back into the business itself. Are they prioritizing shareholder returns right now over maybe investing more aggressively to fight off long-term threats or find new growth areas?
That's a really fair strategic question. And it ties into another little detail, insider selling. There's been a pretty consistent pattern of executives selling shares over the last 5 years. And notably, no open market purchases by CEO Noel Wallace. Now, people sell stock for lots of reasons, but the lack of buying could suggest that insiders who know the company best might see the stock as, fairly valued, not necessarily a screaming buy right now.
Okay, let's switch gears now and really dig into the numbers. Chapter 3. Financial analysis. Starting with the basics, their market cap is around $72.6 billion, so definitely a large cap stalwart.
And those TTM figures trailing 12 months as of Q1 2025, they look really strong. Revenue at $19.95 billion. Gross margin super impressive at 60.81%. Operating margin 21.35%, net margin 14.52%. Their PE ratio, price to earnings, is 25.67. Dividend yield 2.29%, and that great ROIC we mentioned, 29.07% on a TTM basis.
Looking at revenue growth over the last 5 years, it's been consistent but, modest, averaging about 5.1% a year from 2020 to 2024. They had a particularly strong year in 2023, mainly because they were able to push through price increases.
Yeah, those profit margins are really something else. That gross margin over 60%, that comes directly from having premium brands and being super efficient in manufacturing. It lets them keep prices well above their costs. And the strong operating margin, 21.35%, and net margin, 14.52%, just show how disciplined they are with managing costs across the whole company.
But it's important for you, our listeners, to keep in mind these margins can be sensitive. Things like input costs, raw materials, labor, and foreign currency swings can affect them. If inflation really bites and costs rise faster than they can raise prices, those margins could get squeezed.
Definitely. And what really allows them to keep rewarding shareholders is that consistent free cash flow. It dipped a bit in 2022, but bounced back strongly in 2024 to $3.55 billion. That reliable cash is what fuels the dividends and buybacks.
Another thing worth praising is just how predictable their earnings are. Net income has mostly stayed in the range of $2 billion to $3 billion a year for the past decade. Pretty stable, even through different economic ups and downs. That gives investors a lot of confidence.
Now, you might look at their debt-to-equity ratio and raise an eyebrow. It's high, around 11.28 or 11,128%. But it's important to understand why. It's less about financial distress and more a result of their choice to return profits to shareholders via dividends and buybacks instead of keeping it as equity on the books. A better measure might be debt to EBITDA, which is more manageable at 1.65. It shows how many years of operating profit it would take to pay off debt. That gives a less alarming picture of their leverage.
And their low current ratio, 0.85 in Q1 2025, that reflects a very efficient, sometimes called negative, working capital model. They basically rely on steady cash flow and easy access to credit to cover short-term bills. It shows tight operational management.
So all this financial stability really underlines how the dividend is the bedrock of the investment case here. That 62-year streak of increases isn't just history, it's proof of their financial strength. And the payout ratio, usually 58% to 62%, is sustainable. There's room for more dividend growth.
Okay, now for the tricky part. Valuation. Still in Chapter 3. Financial analysis. Let's unpack this. Their TTM-PE ratio is 25.7. That's actually below its historical average, which is closer to 30. So you might think, maybe it's cheap compared to its own past.
But then you compare it to others. It looks kind of expensive next to the industry average PE of 18.
Right.
And definitely more expensive than competitors like P&G at 23.8 or Kimberly-Clark at 17.4. So the market seems to be paying a premium for Colgate's quality and defensiveness.
Right. So to try and get beyond just comparing ratios, analysts often use a discounted cash flow model, a DCF. The idea is basically to estimate all the future cash the company might generate and figure out what that's worth in today's dollars to get an intrinsic value.
Exactly. And just for illustration, purely educational, one DCF model we looked at estimates an intrinsic value for Colgate around $138.34 per share. But, and this is really important, that's just an estimate, it's super sensitive to the assumptions you plug in. Key assumptions for that number were things like long-term growth of maybe 2-3% a year, and that relatively low cost of capital, the WACC, of 5.79%, which reflects how stable the business is perceived to be.
Okay, we are now moving into part 2, Market sentiment, ownership, risk, and conclusion. Let's kick off with Chapter 4, market sentiment. What's Wall Street saying about Colgate right now?
Well, the consensus among analysts, maybe 17 to 28 of them depending on the source, is generally buy. The average 12-month price target is around $101.50. Given the share price of $89.58, that implies, roughly 13% upside. But it's worth noting there's a pretty wide range in those targets from 86x all the way up to $110. So not everyone agrees. And the story you hear in the financial media is also a bit mixed. The bulls focus on strong organic sales growth, expanding margins, basically their pricing power and efficiency working well. But the bears, they point to things like maybe missing analyst estimates sometimes, growth slowing down in certain markets, maybe some recent weakness in the pet care segment. So the debate isn't really about whether it's a good company. It's more about the current price and the near-term growth outlook.
Interesting. What about market indicators like short interest? Are lots of people betting against it?
Actually, no. Short interest is extremely low, only about 1.5% of the float, which is around 12.1 million shares. That tells you very few big investors are shorting the stock. It reinforces that safe haven reputation. And the days to cover is also low, 2.2 to 2.4 days, so no real risk of a short squeeze.
Okay, but what are the charts saying? The technicals.
Well, that's where it gets interesting. The stock price, $89.58, is currently trading below both its 50-day moving average, $90.66, and its 200-day moving average, $92.17. From a technical perspective, that signals bearish momentum, both short-term and long-term. The price trend has been weak lately.
So that's a real disconnect, isn't it? Fundamental analysts are mostly positive, but the price chart looks negative. That could mean it's maybe an opportunity for investors who trust the fundamentals, or maybe the market is just being more realistic about some headwinds right now, reflected in that chart weakness.
Let's move on to Chapter 5, ownership structure. Who actually owns Colgate stock? Well, institutions hold a huge chunk, about 86% of the shares. The biggest holders are the usual suspects: Vanguard, BlackRock. Having such a large, stable base dominated by index funds and big managers tends to dampen volatility. It provides a steady foundation for the stock price.
But what about insiders, management owning shares?
That's much lower. Insider holdings are only about 0.12% of the total shares. Now, for some investors, especially value types, they like to see management with more skin in the game, so that low percentage might be a slight concern.
And didn't we mention selling earlier?
Yes, there's been that consistent pattern of net selling by executives, including
Sure.
the CEO, Noel Wallace. He's sold shares 16 times in the last 5 years, with no open market buys reported. Again, could just be personal financial planning, but it doesn't exactly scream "buy the stock now" from the inside. One other point on ownership: concentration. The top 24 institutional holders control roughly 50% of the company. That gives them significant influence over things like governance and, indirectly, the stock price. It also adds to that overall stability factor.
All right, no deep dive is complete without looking squarely at the risks and opportunities. Let's get into Chapter 6. Risk assessment, using a sort of SWOT framework. Starting with the internal strengths, we've covered these. But to recap, dominant global brands, huge consumer trust, that extensive, resilient global distribution, really superior financial performance, high margins, great ROIC, and those massive economies of scale.
Okay, now for the internal weaknesses. There's maybe an over-reliance on the mature oral care segment. The capital structure is quite aggressive, high debt, low liquidity, perhaps a bit slow sometimes on innovating in those niche trends like natural organic, and that reputational risk from the ESG critiques on palm oil and plastics.
But weaknesses often point to opportunities. There's still growth potential in emerging markets. They can push premiumization and innovation further. There's definitely room to expand the high-margin pet nutrition business, growing e-commerce and direct-to-consumer sales, and maybe making more strategic acquisitions of smaller, niche brands.
Then we have the external threats. Intense competition is always there, from global peers and those private labels. Consumer taste can shift quickly. Big retailers have a lot of bargaining power, and global supply chains are always vulnerable to disruption.
And let's focus on the big economic factors. Inflation is a key threat, right? It pushes up their costs. If they can't pass those costs on fully through price increases, margins get squeezed, and higher interest rates make their debt more expensive to service and maybe make that dividend yield look less appealing compared to safer bonds.
Exactly. And adding to that is a significant geopolitical threat. Those U.S. tariffs announced for 2025. A broad 10% or more on imports, potentially higher from places like China, that acts like a threat multiplier.
Yeah.
It directly increases costs throughout their global supply chain. And economic models, like the one from Penn Wharton, suggest these kinds of tariffs could also hurt overall consumer spending and the economy, creating a tougher environment for companies like Colgate.
Wow, okay, we've covered a massive amount of ground. Let's try to pull it all together now in Chapter 7. Conclusion. Synthesizing everything, the bull case for Colgate really rests on that world-class economic moat. You've got the trusted brands, the global reach, the scale advantages. It's a defensive, predictable business, throwing off consistent cash flow. And it's just a machine when it comes to returning value to shareholders, that 62-year dividend streak, the buybacks, the fantastic ROIC.
And definitely add the Hill's Pet Nutrition segment to that bull case. It's like a strategic jewel, diversifying them into a higher margin growing category.
Okay, but the bear case. You have to acknowledge the aggressive financial structure, high debt, low current ratio that creates some vulnerability, especially if rates stay high. Growth is likely to be modest given they're in a mature industry, and the competitive pressure from rivals and private labels is intense and probably isn't going away.
And crucially, those macroeconomic and geopolitical threats are very real. Persistent inflation combined with the 2025 tariffs. That's a double whammy potentially hitting both their costs and consumer demand. Lots of uncertainty there.
So circling back to valuation quickly, that educational DCF model suggested an intrinsic value around $138 per share. But again, we have to stress for you, our listener, that's just one estimate, and it really depends heavily on the assumptions made.
So where does that leave us? At the current price, around $89.58, Colgate presents that classic investment dilemma. It trades at a premium to competitors, which shows the market respects its quality. But by some measures, like that DCF or its own history, it might look undervalued.
There's really no doubt Colgate-Palmolive is a wonderful company in the Warren Buffett sense. It has so many qualities. Investors look for resilience, consistency, a strong moat. But the big question for you is, does today's market price offer that significant margin of safety a disciplined investor usually wants before buying?
Yeah, it really boils down to what price you're willing to pay for exceptional quality, especially in such an uncertain world.
Well, if you found this deep dive helpful, please do like and subscribe to the Stock Analytics AI YouTube channel. For just $4.99 a month, members get priority access to our deep dives. We're planning to cover all the S&P 500 stocks over the next few months, and members get first dibs. And if you want a deep dive on a specific stock that's not on our immediate list, just drop us a super thanks with your ticker suggestion.
And just the important reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.